Francois Savary, good morning. How are you this morning?
Good morning. I'm fine, thank you.
Welcome and thanks for joining us. Let's go to the week ahead. What are you most looking forward to?
Obviously, the one I'm looking for the most is the non-farm payroll in the US. And also, it needs to be connected with one key element for the Fed, which is the average early earnings. It is expected to have come down a little bit to 4%. This is a key element in the discussion among the Fed members, because this is where they want to see that wage inflation is coming down. And you can relate that to a number that is going also to come this week, which is the productivity, the labor productivity and unit labor cost. And I think those are the key elements that I will look at. I will also look at Japanese numbers because you have the Tankan numbers that is going to come on Wednesday. You mentioned that the GDP in Japan is going to come out. This is also an important factor. I think that also what you need to watch carefully is the retail sales in Europe. We all know that Europe is facing recession condition or some kind of recession condition risk. It's very important that the consumer, who has been saving for quite a long period of time, begins to spend a little bit of money. So retail sale is going to be something that we'll watch carefully in Europe also this week.
You mentioned China just in our conversation a few minutes earlier. Can you go through that at the moment?
I think China is very important also. Sorry, I forgot to mention, but you have the trade numbers which are going to come out during the week. People are going to look at those numbers because they are very important in terms of giving us an idea if the Chinese economy is able to recover. People are expecting some rebound in exports and imports, which would mean that consumption in China is making a comeback after a few months that were a bit difficult. In general, I think that people need to put some attention on China. There are some development, Evergrande. There was the decision to postpone the liquidation of the company, but it is also telling you that the real estate problem is still a huge problem for China, and it's going to remain. You have also the fact that more and more people have the impression that the third plenum of the party, which is supposed to take place in October and November, is going to be postponed to next year. Why is it important? Because this plenum usually is the one that deals with economics and the economic management. It tells you a lot about the Chinese authority caution in terms of where they are in terms of economy. It means that they want to have more time to think about the measures they need to take to tackle the problem that they face, which is low growth, which is real estate bubble, which is financial risk. So it's very important. China remains a key element in the global background economically.
Let's go to gold now. You called gold correctly a few times and several weeks ago. Back then, I think your target was about 2,150. Gold has broken its all-time high. Where are your levels now on gold for the next 6 months? Say?
I would say that after some kind of consolidation that is due in the short term, because the move has been quite impressive since October, so a setback is possible, maybe 100, 150 US dollar. I think gold price is going towards 2,200, 2,250 in 2024, because what we are seeing are more and more signs that economic activity in the US is going to calm down. I think that interest rates are going to come down in 2024. Therefore, I think that gold price is going to benefit from that. I think that you don't have a lot of potential safe haven in the current condition. I am considering that the US dollar is going to be weaker in the medium term. So I think that you have all the conditions for gold to continue to move higher in the coming 12 months.
Talking about interest rates, Jay Powell last Friday, to my mind, was slightly negative, or very negative even. He said that he doesn't mind increasing interest rates again if the data supports it. The market actually liked what he said. Can you interpret that? In what way?
Okay, I think that you have two elements. As you mentioned, he said if the data supports it. Currently, it's not obvious for many, but you can say clearly that you have numbers that are showing you that economic activity in the US is slowing down. You had the ISM number coming on Friday. It clearly shows that it was disappointing, that there is still contraction on the manufacturing side. I think that you have different numbers on the inflation that are telling you that the fight against inflation is going to be won. So first of all, the support, if it's supported by the data, I think that for the time being, the data are not supporting a further rate hike by the Fed. What is also very interesting is the reaction of the market. You are right. When he said that, the market react negatively. But then he mentioned a few minutes later a change of wording from saying that the monetary policy was restrictive to well into restrictive territory. This is where the market began to consider that it was a positive message, because well into restrictive territory means that there is no such great, I would say, space for further interest rate hike. So this is a game on words that the market interpreted. I agree with you. The reaction was overdone to my point of view, but nevertheless, this is the way the market reacted to the comment.
France and Germany announced they were in recession last week. With Jay Powell's speech last Friday, isn't it time for stock markets to take a breather and consolidate?
Yes, I agree with you. I completely agree with you. I mentioned already last week that I was a bit worried by the equity market run. November was a huge month, not only for equities, but also for bonds. Down the road, at the end of the day, 2024 is going to be a fight between interest rates and earnings. This is the key elements that you need to have in mind. Interest rates are going to be supportive if you remain with the market view that interest rates are going to come down in Europe, in the US in 2024. But then you need to have the earnings component that is with you, because currently the market is expecting in the US 11 to 12% earning growth in 2024. In an environment of slowing down activity in the US, it seems difficult to consider that it is a realistic forecast to have 11 to 12% EPS growth in 2024, except if you consider that they are able to increase their margin. So there will be a fight in the coming months between earnings and interest rates. I think that November has been completely under the influence of interest rates, because it is the very positive scenario for the equity market. Over the coming weeks, we will get closer to January. January is going to be the earnings season for the fourth quarter that will begin. And then we will see if the guidance of the companies in the last few weeks, which are not being that positive on the top line, saying that the condition were deteriorating, it will be interesting to see if the earnings season of Q4 is going to show that there is, in fact, not such a rebound in earning as many people expect. And this will be a time space where then the confrontation will move towards earnings and it could weigh on the market. So I agree with you. There is time for consolidation over the coming months. There is time for people not to jump into the market right now. People need to be cautious not to enter at the wrong time. And I think it's not the right time right now to get into equities with such high level on the indices, especially in the US.
Let's go to Japan. You called a buy on the yen a few weeks ago, quite rightly. The yen is slowly retreating from its lows against the dollar, 146 this morning, I think. The Bank of Japan must be very happy with that. They have needed to intervene in the markets to support the yen. Where do you think they'd like the yen to go? And how is this going to affect Japanese markets next year?
I would say that the Bank of Japan needs to be very cautious. What they want to avoid is too much of an appreciation of the Japanese yen. As you mentioned, yes, they look at the recovery of the yen positively. Why? First and foremost, because it reduced the import inflation into Japan. And that's a key element, because at the end of the day, the Bank of Japan needs to decide if they want to change course in terms of monetary policy. As you know, the Japanese central bank is the only one in 2024 who has been very, very cautious and made only very slight move in terms of adjusting the monetary policy. I still believe that they will act in the first quarter of next year. They will increase interest rates, and they will make something on interest rates because they need to do it, because the economic conditions are quite satisfactory. They have regained control on. Now they have inflation that is satisfactory in Japan after many years when it was not the case. So there will be caution in the action of the central bank. That's the reason why I mentioned a medium-term target for the yen. I would say, I was moderate in my forecast, saying that I think that next year you will see 135, 135, which is not a huge appreciation, but it would be an appreciation that is strong enough not to increase inflationary pressures in Japan, but limited enough not to weigh too much on economic activity. And I think that's the reason that I mentioned this target. What does it mean for the Japanese economy? It means that maybe 2024 was a very good year for the equity market. It's up more than 25% in local currency term. And I think that next year is going to be more difficult and very dependent on the development on the currency. If I had to make a choice in terms of Japanese equity, considering my view on the yen, I would more favor the small and mid-cap company and not the international company, because the small and mid-cap usually are more domestically driven. And I think that they could benefit relatively compared to international companies in an environment where the yen is appreciating.
Can you see an unwinding of the yield play between the yen and the dollar after all these years?
Yes, I can see that. And this is the reason why the Bank of Japan needs to be careful, because it could be, quote unquote, dramatic if suddenly you had Japanese investors who, it's known, have made a huge bet in getting out of Japan, going into European assets, into US assets in particular. If suddenly, because the Bank of Japan act too decisively, suddenly decide to get all the money that they had in foreign currencies back into Japan, because then it will make the situation for the Bank of Japan monetary policy very difficult to manage. It could be a blow to the international economy, because all those move of investment flows, financial flows coming back into Japan will reduce the liquidity in the Western world. So yes, it's something that we need to be aware in 2024 as a risk, that it's not going to be that easy for the Bank of Japan to promote a change of course in monetary policy, a moderate appreciation of the yen. In a way, this kind of perfect scenario could be facing some headwinds, and you need to be careful with that.
Francois Savary, thank you very much. Speak to you next Monday. Bye.
You're welcome. Bye-bye.